Hey, good morning, everyone. Welcome to the live stream, and we are getting up here. It is 6 a.m. on the West Coast. It is 9 a.m. on the East Coast. Let's talk about stocks. It's been a week with ups and downs, and yesterday was a pretty good day. It didn't end as nice as I thought it was going to end. I think I left to go to the Stonk Studios around 11 Pacific, which is 2 p.m. Eastern, and the markets are had healthy gains in the last couple of hours of trading. They gave up some of those gains, which was interesting. If we look at the markets where they're trading at this morning, it looks like we're going to open up higher, and it looks like the Nasdaq's going to open up 0.65, S&P up 0.30, and then the Dow is going to open up just slightly higher. Not bad, not bad. Like looking at crypto's been kind of going down. It went down substantially. It's went up and now it's back down. So I'm not sure where that's going to go. But if we look at yesterday's trading, I'll show you the example that I was referring to. Let me look at the 5-day. You can see that yesterday, the market went up. It was trading nicely, and then it gave up a lot of gains toward the end of the day. A good part of that, I'm sure, was NVIDIA. NVIDIA did go down substantially yesterday. The market just, I don't know. I would be pretending that I knew exactly what the market's thinking. But NVIDIA over the last 5 days, the 5-day doesn't look too bad because they gave up more than 6% just yesterday. But we'll see what the story is with NVIDIA. It looks like it's going to open up higher this morning when we open in about a half hour. And I think that the NVIDIA story is just beginning where, hey, where is the market going to trade NVIDIA going forward? I think it's going to take 2 to 3 weeks for that to really be understood because the big investors that are in NVIDIA, I think their decisions are going to really move the stock. I know it's an awesome retail stock. That's great. But if you look at the actual ownership of a large cap stock, a big part of that ownership is institutional investors, hedge funds, these organizations that have massive amounts of capital. And when one of those guys exits, it really catches everybody's attention from the institutional investor side. And those are the guys that if they leave the stock, it could really fall quickly. On the flip side, if you see institutional investors enter the stock, it could really make the stock go up. I don't know that retail investors are going to be, very are going to move the stock a whole lot because they already are involved in the stock. They've already been pushing up the stock. So I don't know that they can push even harder. I think as I read Reddit threads, I'm seeing retail investors get out of the stock, which is interesting. I think they're beginning to take some money off the table, and as they should. I think diversification should be a part of every investor's toolbox and make sure that they're capturing some of those gains, because gains, you don't make money on a stock until you redeem that gain. You could be up on a stock 100%, it could crash down 80%, net you made 20%. You can't claim, hey, I made 100% on that stock. So I think NVIDIA, and I think super microcomputer would be a good example. At one point, investors were just crushing it, and then that became a falling knife, and now it's just falling quickly. So looking at the comments, I encourage you guys, if you want to look at companies, let me try to catch up here. Looks like a lot of comments have come in since I started streaming here. So make sure I catch any symbols that people want to see. Acer 8, looks like you're in. Thanks for joining, man. Appreciate you. Crypto Miner, Do Me Trash. Okay, you want to take a look at PRDO. PRDO. And we'll take a look at that. Do Me Trash, Acer 8. Thanks for joining. All right. And then LMAO is a symbol that is of interest. We could take a look at that. So it looks like Acer 8 just got done with a cream cheese Danish and first cup of brew. Man, you're making me hungry. I've got my brew, but I can't eat while I stream. I'll try to drink coffee while I stream. All right. So we've got the market is, headed in the right direction. Okay. So it looks like LMAO is not a symbol. Scratch that off. So it looks like the futures are going to open up on the green. Hopefully they keep those futures. I don't know where you're sitting at, individually with your performance for August. This is the last trading day of August. And the first couple of days of the month did not look good. They actually look pretty damn awful. If you look at, let's see here, we've got, so we ended July, and then the first couple of days down 8% on the NASDAQ. I mean, it just went down fast. So I thought, boy, this is going to be a long month. This might be one of those months where we have some pretty good haircuts on stocks. And to my surprise, the stock market said, no, we're not going to do that. We're going to go up. And we actually regained what we lost at the beginning of the month. So I'm sitting on a pretty good gain for the month. It's a modest gain. I've had superb months, especially over the last 2 years. This one, I'll take it. I thought it was going to be a terrible month because the first couple of days were kind of guiding toward, they were guiding toward being terrible. So at this point, I'm like, all right, cool. I think we're good. I think we're good for the month. So barring a collapse in the stock market today, I think I'm going to have a good month. Very good. I try to organize my portfolio so in a year, the performance is very good. I measure performance each month just to track, how that month went. I track the 3-month performance, that would be the previous 3 months, year to date, and then I look at year to year just to see how I'm tracking. It's just a way of just measuring, how I'm evolving my portfolio and trying to get better over time. So we got through the market here. Just some news. Inflation looks like it's being controlled. The PCE, personal income and personal expenditure index that the Fed likes to see, came in as expected. Spending came in as expected. Income came in a little higher. And all just this means is there's no bad news. It came in as expected. It's being priced into their interest rates. It's being priced into the market. So no big surprises there. So that's good. All right. So we'll get rid of the news. Now let's talk about sectors really quick, and then we'll jump into the stocks that we want to take a look at. So yesterday, energy stood tall, and that's been going up and down. I can't say that it's been, the 1 month change hasn't been all that great. So energy was all right. Materials stood tall. Financials have been doing really well. I've noticed that for the last month, certain spots of financials have done really well. I like insurance and financials. I own Robinhood. That's been a real good winner for me. And overall, for the year to date, it's doing well. That's cool. Industrials, that one's kind of tricky. I'm not quite sure where we are with industrials. The economy is doing okay, but we're not about to explode in growth or anything like that. And I think certain industrials look good, but certain industrials look a little expensive. Believe it or not, Uber isn't an industrial. They're considered a transportation company, and they're in the industrial sector. Healthcare continues to be a sector and types of companies that I like because they've been left behind. The technology stocks have taken a lot of that capital. And they did well yesterday, have done well for the last month, are doing well year to date. So I'm glad to see that. For a while, like 18 months, I was seeing healthcare near the bottom, and I'm like, hey man, those guys are better. It's like we're about to start football season, so throw a football analogy. It's like healthcare is one of those, teams that's always competitive, but you see them at the bottom of the rankings. And you're like, geez, man, what's wrong with this picture? They have the right players. They have good value. They have very good fundamentals. Why aren't the stocks moving better? And I think part of it is, the whole AI thing is grabbing a lot of that value out of the market and making it go to technology. Technology had a down day. I think Nvidia is pretty much most of this number, staples, and then real estate. So that's where we're at with sectors. All right, so let's jump into some stocks, and we'll lead off with a request, PRDO. This is Producio Education. I have looked at this company. They have been doing really well. These guys have strong fundamentals. From the last time I looked at them, I haven't looked at them in 3 to 6 months, but I could say that they have very strong fundamentals, and they are a tiny cap. So $1.48 billion of free cash flow. And the revenue is $662 million. So you're buying the company a little over two times revenue. But you see, they have really good net income, and their PE is really low. Forward PE is 9. These guys, what is good about them is they started like online education at the right time, and they've done really well with it. They also try to focus their curriculum around degrees that people get jobs in once they're done with the degree. Very good idea. Like, they're really into computer science, engineering, cybersecurity, criminal justice. I mean, there's a lot of jobs there. So I think it's a very well run. I would say it's a very focused company. The one thing that I always thought, now I don't use this as like a big issue, but when I look at their website, it was always super simple. And I'm like, it doesn't cost a lot of money to hire somebody and have like a real nice professional presence online. I mean, if you're Berkshire Hathaway, you're $1 trillion market cap. And if you saw their website, it looks like they put like $5 of investment in their website. This one is also that way. It's like just not the cleanest website. And you'd think that it would be an elegant website like a company that's attracting students should have, but they don't. No big deal. All right. So they do education services. They have good fundamentals. The last time I looked at them, so again, they've had good growth in the past, right? Especially, and they weathered COVID quite well. You could see that. When we look at the quarterly, the revenues are down. Now that's interesting that revenues are down on the quarterly, right? Sequentially, we're going from 178 million of operating revenue in that quarter down to 146, 167, 165. And this is year over year. So it's measuring the previous year quarter. So we go Q2 of 23. So we were at 184. Now we're at 165. So to me, this is a concern. Why are you, when you compare the quarter this year, because you probably have seasonality in their business, like, at certain times of the year, you're making more revenue. This is education. So maybe in the middle of the summer, not a lot of students, not a lot of revenue. In the winter, in the fall, winter, spring, lots of students. That's where you have a higher amount of revenue. But I would have to look into this. I'd have to understand why. Is this like a longer trend that is going to make the company far smaller, which would make the value of the company far lower? I'd really need to understand that. That'd be a must research and explain item for me. Okay, so that's the revenue. Let's take a look at, I think their balance sheet last time I looked at it was good. Cash 674 and debt is 23 million. So really no debt. Very good. Excellent balance sheet. Free cash flow. So they're at $134 million of free cash flow. That's very good. And they've been a cash flow company. You see that there, that they've been cash flow positive. And that's good. That means that, hey, they know how to operate their business efficiently, make money, and have that cash available, have a big cash balance on their balance sheet and no debt. It's a very strong position for a company to be in. So if we look at 134, they're not a growing business, which is kind of a concern there. I'd have to understand that. So the best I can do is multiply 134 times 10. It gets me to like 1.3 billion. But then if you add the cash, you could say that these guys are a little bit discounted. I think the party has been going on for a while. The stock has been appreciating. Looks like they announced earnings here, and there was probably something around their announcement here that they announced and the market really liked. This was around May 2nd. So if we go back into the news releases, so May would have been 3 months ago. So yeah, there's no story that I'm seeing that really drove that difference. I guess it was around one of their earnings, probably the previous earnings, because see, this is July 1st. No, I don't know why the stock really rallied this way. That'd be the second item that I'd want to understand what happened. So this is an interesting stock. It's a small cap, has strong fundamentals, but the to-do list on this stock would be, you got to figure out, why is their quarterly revenue declining? Is that the beginning of something that's going to be a bigger problem? And second, the rally, what caused the rally? It may be a bad time to buy the stock because you could see that not too long ago, the stock was trading at half its value. And, it over the last 5 years, it's gone down and it's gone up. Well, if it goes down again, are you sitting on a stock that's going to begin to depreciate? I don't know. I think it's got enough to be interesting. It's a small cap, but it would be a little bit late into investing in this stock. Is this a long-term stock for me? No. Stocks like these are, I think if I see the right things, I could see myself owning them for a couple of years, unless the company just keeps getting better and better and better. But I just don't see that in this space. I think this space is going to have probably a couple of years of performance, maybe a year of performance, and then you've got to have a good exit strategy or a good exit plan, I should say. It hits a certain level, unless the business is really innovated and become stronger, and better, then maybe that's the catalyst that would keep me in the stock. But I'm not in love with their industry. It's not an industry where I'm like, wow, these guys are super valuable, super profitable. I think it is interesting though. And obviously investors that bought this stock not too long ago, in April, they're sitting on a really nice gain. So congratulations if you're one of those investors. Yeah, good one. That's a good little company. So it looks like Trader Prad, thanks for joining, man. So it looks like somebody was looking at AGNC. So, and FYI, I don't have a moderator. It's a one-man show. If I miss your comment, I apologize. But the chat is got a lot of stuff going on, and if I miss, I apologize. Please repost it. Like, hey, dude, I want you to see this symbol, and please do that, because if I miss it, you'll know that I'm just trying to do a couple things at the same time. I'm not ignoring you. I just didn't see it. Okay, so AGNC Investment Corp provides private capital to housing market in the United States. It invests in residential mortgage pass-through securities, collateralized mortgage obligations in which principal and interest payments are guaranteed by the United States government. Okay. So this is like financing for the real estate industry. And so these guys are considered a REIT. So I'm going to take a look at, just to kind of get a sense of what the company's all about. Selecting high quality assets. Okay. Okay. So they work with Fannie Mae, Freddie Mac. Okay. Now, the mortgage industry, and whenever you work with the government and you work with real estate, historically it's low risk up until the subprime mortgage meltdown that happened in 2007, which caused a lot of pain. But I think we're going to go back to more historic trends in that industry. Um, so it's an interesting idea. The stock over the last 5 years hasn't really performed. Over the last year, it hasn't gone anywhere. It's just flat. Man, look at this dividend. What is up with that dividend? And it's not like MPW is a high paying dividend stock that's just been it's been it's been like a stock that's disappointed on a few occasions. MPW. This one is 14%, and their stock has been stable for, I'm going to call it stable for a year. They had kind of some type of scare here. Whoever understood this best, made some good money because they're sitting on appreciation and a big dividend. All right, we'll take a look to see if that dividend is safe or if it's not. This is going to be a nice income stock, but at this dividend rate, I would actually put this in hey, this isn't a bad investment to have because, yeah, I love having stocks like, let's say, a Robinhood or an Uber. Those suckers appreciate, beautiful, love them. But hey, let's also invest in some companies that are just going to drive a 14% return like this one, kind of like a different way, which is through income. Maybe. Let's take a look. So this is a REIT, but they do financing. So the financials are going to be a little funky. So let me get my head around them. You see how you have revenue here, right? And in 22, they probably had a lot of losses. They probably had to write down a lot of assets and loans. And it looks like, oh yeah, interest expense. That's it. So the Federal Reserve went on their interest rate hikes that were like really difficult for financial companies like Silicon Valley Bank. If you remember, that bank went bankrupt because the Federal Reserve increased rates so fast. So that's where the losses came. And Silicon Valley Bank did recognize losses, and that's what drove the run on their bank in early 2022. And it became an opportunity. Whenever there's big problems and a lot of fear, that's an opportunity. That's when, like Warren Buffett, I love when he says, the stock market's kind of crazy. If you thought about a department store and you're in this, let's say you're in a Best Buy and you're like, all right, cool. I'm looking at all these electronics. And then Best Buy says, hey, everything's 50% off today. And everybody runs out of the door and says, oh, no way, I'm out of here. I'm afraid. Why are they reducing prices so much? And they all run out the front door. Well, the stock market basically is like that. When like some new stories get out there and they put a lot of fear in the market, in the case of rising interest rates, a lot of investors didn't understand what the ramifications were. They were just seeing losses, but these were paper losses. They weren't real life losses where like, oh no, they have to write a check for $1 billion. So it became a really good opportunity. And you can have made really good money in the finance industry in 2023. in early 2024. I digress. Sorry about that. So we are dealing with financial services or financials, mortgage lending company within REITs. So now they're in a revenue band. We're going to have falling interest rates, which is going to be good for them. That's good. So they do have a funky financial statement, but understood. They have a different business. We're not going to see if you look at the balance sheet for a REIT, you're going to be like, whoa, they have a lot of debt. Yes, because they carry a lot of assets. So yeah, like if you carry a bunch of real estate and you're a REIT, you're going to have a lot of debt because they both are balancing each other. These guys, I imagine, are going to have a fair amount of debt. They do. That's because debt is actually, it's almost like a material. If you thought about a manufacturing company needs materials and components, right? Let's think about Dell Computer, which is a stock we're going to analyze. They got to buy motherboards and CPUs and chassis and all kinds of stuff, and then make computers and then ship them out to people like myself. I'm running a Dell, and then we get our computers and we go, thank you. So their materials are a physical form. For a REIT like this, their material, one of the key components is debt. They manage debt. They capitalize on debt. They make profit on debt, but they have to do it right. If they don't do it right, they go bankrupt. Yay. So dividends on REITs is different. You do not use the normal method of looking at a payout ratio. So this website, I don't know if they're right or wrong, but I'm going to validate it. If they're using like the method you would use, I got my dividend on Starbucks today, so I'm drinking coffee for free today. $136. Boom, right ahead of a 3-day weekend. That's a small dividend. I have some dividend payers that pay me over $1,000, but I'm going to celebrate Starbucks anyway. So if you use the methods that normal companies have, you come out with the wrong number. You have to take funds from operations is a different factor on a dividend or on a REIT. So let's go break open the financials, get to funds from operations number, and I'll calculate what the payout ratio is. Because if the payout ratio is good, this stock might be interesting, especially to income investors. Like, hey, you know what? That's pretty damn good. So let's take a look at quarterly results. We're in Q2. See how elegant this website is? PRDO's in the previous stock, and they're in like the education kind of business. It doesn't cost a lot of money to have a nice website, which is a surprise when I look at companies like that. You'd think, yeah, if you're going to go to an interview, put on a nice shirt, maybe a tie, nice coat, brush your hair, that kind of thing. Websites are like, that's the dress code to companies online. They got to put a nice website out there. And that's not that expensive. It's not like, hey, you're going to have to spend a ton of money. Okay, so just show me the document, guys. Don't make it hard on me. Make it easy. Okay, so here we have the balance sheet, and I know it's going to be small. So once I find everything, I'm going to zoom in. So give me a second. So here's your income. They're going to have a different schedule that is going to have funds from operations, and that's where I'm going to get to. Huh, they didn't show it there. So they're not showing it, so yeah, they're not breaking that out on this schedule here. So let me try to find it a different way. So I'm studying their presentation here, trying to get to funds from operations or the information that's going to lead me to a conclusion of can they afford that high dividend? Because really that's what this stock presents as that's what is attractive to this stock. So give me a second. So it looks like these guys, since they're doing more of the financing, what's throwing me off is they're labeled as a REIT, but maybe they don't have the same attributes as a REIT. REITs look at funds from operations, and then you compare that, and you should. It's a requirement that they pay out a certain ratio of funds from operations. That's why they pay high dividends. This one here, the homework on this stock, if you're interested in it, is you have to determine if they can afford that dividend. Um, I'm not getting to the right information, and I'd probably have to examine this quite closely. Um, and if you're interested in this stock, you'll have to do that. You'll have to examine their financials and then figure out what are they really, uh, how much cash flow are they driving, and it is how many funds they're driving out of operations, and can they afford that high dividend? Because if they can't afford the high dividend, they'll have to cut it, or they're gonna get themselves into a lot of trouble. So that would be the homework on that stock. It is interesting to me. Usually, high dividend stocks is the situation is so the situation with the stock. I'm going to compare it to another stock that I know has a high dividend that is troubled. So this has been historically a stock that has a high dividend, but look at the performance, minus 39. Yeah, you're trading a high dividend rate for very low, declining a value of your asset. That's not a good exchange. You lose 34% to make a 10% dividend. That's a terrible investment, right? And the foundation of your investment is the value of that company. These guys have maintained their value and have paid investors a very healthy return. Now, what was going on in late November? We had a pretty good correction in late November. It started in October and stocks sold off. So this is not totally weird, right? If we look at, I'm going to look at the NASDAQ and show you that that drop was probably from a correction the market had. If you see, here's the NASDAQ. This is a whole index. See how the market was going down. So it just sold off a lot of assets, especially ones that seemed risky. So that one's a pretty interesting one. I think it'd be worth putting a few hours of time into it if you're an income investor. Okay, and this is potentially a nice yield that you can make over the next year or so. I'm going to look at it a little closer and see if it's a good one. So thanks for bringing it up. Sorry I couldn't get to a conclusion. That one's just really different. I've never really looked at a REIT that does financing, but I appreciate you bringing it up. So it looks like, yeah. So all right, cool. So we're gonna keep rolling. So I thought we can look at DELL. DELL looks like the market's opened. So let's take a look at that. And markets are open. Nasdaq's up 0.72, S&P up 0.5, and the Dow is up as well. Very good. So Dell had a very good day yesterday. I should say after hours trading. Now, what's interesting is it didn't hold its gain in after hours. Wow, what the heck? So that was a head fake. That is officially a head fake. If we look at Dell for the last really 24 hours, it's been a little bit of a roller coaster. So if we look at this, it jumped up and then it came down and now it's back up. And this doesn't measure after hours, so it really doesn't give us the full roller coaster. Now, Dell earnings were perceived to be positive, but this isn't looking all that positive. So that's interesting. That was a little bit of a surprise. I thought it was going to hold its up 5% in after hours trading, but I guess it didn't. Investors thought differently. These guys are really benefiting from the AI build out and the data center build out. So data centers are receiving more and more investment. They're a $78 billion market cap company. You're buying it, you're buying the company for less than 1 times sales. They do have net income. The one thing I did notice in their financials, and we're going to go through the full evaluation on this one, where we look at, the spreadsheet model that I've put together to value companies. And what I'm seeing here is that their cash flow did go down. Analysts say it's a strong buy. It's discounted by 18%. And they're basing that on earnings per share, which I agree with them on earnings per share, but cash is king. Free cash flow is the principal method that I use to value companies. And when we look at cash flow, it's going to be a little different picture. When we look at revenue, it's been going down generally. If we look at quarterly, it is moving up. They grew by 9%, and they have a lot of revenue. This is a big company, so 9% is pretty good, pretty good. Now, they're not super profitable because they're a hardware company, so that's part of it. That's why I don't love hardware companies. I'd rather have companies in technology that have greater margins. Software, Google Alphabet, like NVIDIA has tremendous margins. Now, their free cash flow, you can see, has been declining. That is a problem. Okay. So if we look at the trailing 12 months, it actually declined quite a bit. And it kind of makes sense to me. When I look at their free cash flow, see, in the past, they produced a lot of cash, and then they had a bad year in 23. All right. They had a decent year in 24, and then they had a reduction in the trailing 12 months. And I could see that they're putting more capital into their business. And it makes sense if they're gearing up for, I think PC sales are picking up. So they're probably updating their, assembly lines, warehouses, that types of logistics centers and so forth. That makes sense. But it's just reality that free cash flow is going down over time. They used to be 7.5 billion. Now they're down to 3.3, and then the previous year at 5.9. So that really did reduce the amount of cash flow that I am considering for Dell. So let's take a look at Dell. And I already updated all these numbers, so I'm going to make the spreadsheet bigger so you guys have more real estate to look at. And when I look at trailing 12 months, and the number is a little hard to see, so I'll explain it to you. Trailing 12 months is $3.359 billion, and I'm going to increase it by 10% to get started. It's the growth rate. And then I'm going to grow the first 4 years by 10%. That's my cash flow forecast for the company. And then after that, they're going to grow by 4%. The company is a good company. The debt to EBITDA ratio is fine, but they're just in a hardware space, a little riskier. They have to carry inventory. If they carry the wrong inventory, they have to write it off, and that could be risky. The intrinsic value of cash flows is 80 billion. And then I add cash flow from their balance sheet and take away debt to get to an equity value of 60 billion, but their market cap is 78 billion. So that is the company is being priced at a premium of 27%. When you look at earnings per share, yeah, you can make earnings per share look, the stock looks like it's discounted, but this is the method that I trust most. And some of the legendary investors, cash flow is king. You can look at earnings per share. It's a number that has a lot more influence by the company, and some of it is just because the government makes, or generally accepted accounting principles force them to report a particular way. Some of it is an opportunity for them to influence a number and make it look prettier. Overall, this stock is being sold at a premium of 7%. It's in an industry that I'm very careful with. So I bought shares going into the close because I wanted to put a little extra interest level going into the stock prediction. And for a little while, I thought I was going to make a few bucks. But at this point, the way the stock price is trading, I'm not going to make any money. I'm going to sell the stock probably as soon as I get done with this live stream. Now, this isn't a stock that I would buy. I would totally pass on DELL. It's just not, I don't think DELL is going to be a company that's going to be worth twice as much in 5 years for me. It's not in an industry that produces high margins. We just went over cash flow. It has declining cash flow. So it's not a stock for me. Maybe it is for somebody else, but that's my opinion on DELL. And it is interesting that the stock had a very good after hours session, and now it's up 2%. How much did I buy the stock for? See if I made enough to buy a cup of coffee. So I bought shares. I bought shares at I guess $112 per share. So I made $1 share. I made $10 if I close right now. So I just wanted to have a little fun. That's why I bought the stock. But all kidding aside, it's not a great industry for me. I try to avoid it. And we just went over a valuation for DELL. So, all right. Shadow Guy. Hello, sir. Thanks for joining. One of the regulars on my live streams for a long time. Appreciate you joining. You were on the phone with your bank in Germany. Oh, man. And do you speak German? I think you do. So I know you speak English, but very cool. All right. So moving on. So another company that I want to look at that kind of pairs up nicely with DELL is Hewlett Packard. And Hewlett Packard a while ago was I'm going to call it, it was two parts. It was Hewlett Packard that we recognize today is the consumer products company, laptops, printers, peripherals. Then there's HPE, and Hewlett Packard Enterprise, and they do more, servers. They're trying to get into the AI race. They do professional services and stuff. And I own HPQ. Now, HPQ has been performing, I think, reasonably well. Over the last month, they're both up a little bit. Year to date, Dell's up a lot. Dell's been a pretty good performer. And over the past year, man, Dell's up a lot. And I think it's at the whole space of hardware. Super microcomputer is showing us that, hey, that space really swelled up and now it's beginning to collapse. And Dell, I don't know where it's going to go from here, but I think it's going to be a little bit of a sketchy ride. I think Hewlett Packard's a pretty good position for me. It's up 21% a year, and it pays a decent dividend. It announced earnings this week, and they announced them on Wednesday. And since Wednesday, the stock's doing okay. It rose nicely the day after earnings. And this was one of those stocks where after hours, the stock really went down. And then the next day it opened up really high and it stayed high, which was fun to watch. It's a $34 billion company, $53 billion in revenue. They have a low PE. These guys do laptops, computers, and stuff. And the reports that I've been seeing is that during so once we got into COVID, right? Everybody realized, oh man, I got to do my job online. My kids have to get online, get on Zoom, do their classes. So there was a huge refresh of hardware because people needed better computers, better cameras. They needed cameras to work. And that really created a nice upward path for companies like HP and Dell and so forth. And these guys went up. And ever since then, the hardware refresh was done in 2020, 2021. Then they had kind of a little recession within this industry. Well, that recession's kind of over, and you're seeing that refresh cycle start again. So I'm seeing that, and I like that about HP. It is a little more of a stable company in my portfolio, but I have liked the return. I do like their management. They pay a 3% return and a 3% dividend, excuse me. Analysts think it's fairly priced and it's a buy. Take a look at their revenue. This is where the revenue really went up, stabilized, and then it went down, as mentioned. We look at the more recent quarter. You're seeing that trend, right? These cyclical trends, semiconductor and hardware and so forth. You see where consumption goes up because everybody needs a laptop, everybody needs a computer. Okay, everybody has a computer. Okay, well, we don't need that many computers. It fades down. So we're beginning to see the beginning of this trend. So I think for the next year or two, I'm optimistic that these guys are going to see growing revenue. Their cash flows are always decent. And I already updated my valuation model on this guy, so I'm going to be ready to show that to you. But you can see that they've stabilized their free cash flow. This is the quarterly. Yeah. So free cash flow, nice and stable, nice chunky cash flow. It's not the most expensive company in the world, right? Looking at like Apple, right? $3.4 trillion. Hewlett Packard, and that's a hardware company. Hewlett Packard, 34 billion. That's like this, like a, I don't know if this is kind of like a small medium cap. I mean, what is medium now, right? If you got Apple at 3.4 trillion, is mid cap 500 billion? It's hard to make those decisions now. I think that small caps are like 25 billion and under now because valuations are so expensive that you can't say, oh no, a small cap's $1 billion or under. Really, well, Apple and Microsoft are well above $1 trillion. So we got to get closer to that number now in these classifications, in my opinion. All right. So Hewlett Packard, that's the company's about. I don't think anybody needs a full explanation there. They do computers like the computer you're looking at, and they do it primarily for the typical student, the typical business person, the typical consumer. When we look at their valuation, I think they provide a decent discount. So I like that about them. They have a very low PE. Their cash flow really proves solid foundation of value. So this is a company I like to have. I like keeping Hewlett Packard in my portfolio, just having it nice, stable, get a nice gain going on the stock. I need a couple of stocks that are easy. It's kind of like, you have a garden and you have a certain plant that's like super high maintenance. And it's like, oh man, it's such a pain in the neck. So you really appreciate the other plants that look nice and they don't require a lot from me. That's what Hewlett Packard's all about. So I like that stock. Hewlett Packard. What's it doing today? It's up 11%. I'm sorry, 0.1%. So not breaking any records today, but that is a stock that I cover. All right, let's take a look. So Pyro, thanks for joining, man. You're on my favorites. Hey, thanks, man. I appreciate that. I appreciate that a lot. Shadow guy, na klar. Are you speaking German to me? Um, okay, so from here, let's uh let's talk a little Lululemon. So Lululemon, right? This story is really getting interesting. So when when there's certain companies, like I bought Nike recently, and Nike and Lululemon, um, to me, they are similar, and I'll explain why. So both of these guys have seen better days behind them. You can see that, we got into COVID, and then in the US, the government said, hey, well, we can't have a financial crisis combined with a health crisis. So they started mailing out checks, and people had all this, stimulus checks in their hands, and corporations made out like bandits. They had the what they call those funds, PPP loans that they didn't have to pay back. I mean, it was a time when the government really infused a lot of money into the economy. Not a big surprise. Um, you know, People were like, "Okay, cool. I just got 500 or $1,000. I forgot how much they sent. I think I didn't qualify for a lot of them because I make too much money, and people got those checks, and they're like, "Cool, I'm gonna get a new pair of Air Jordans." Or a lady might be like, "Cool, I'm gonna get some new Lululemon accessories, and I'm gonna get some new yoga pants, and I'm gonna get a nice top and spend $300." That really, I don't mind spending because this money was given to me by the government for free. So you could see where they really rode that cycle up, both companies. And then they're like, all right, now you got to deal with a non-stimulated economy, and they both came down. Okay. And Lululemon rose again. Nike did not. Nike has slow growth. We're going to look at Lululemon growth next. But when we look at companies, there's a really important piece to or overall strategy in my investing approach, which is the way that I can make money for a long time. And what I like looking at some stocks that I bought 5 years ago that make me money, that made me money for the last 5 years, collectively made me a lot of money. They make me money when I sleep. They make me money. Okay. Great stocks. Those tend to be in this green box. Okay. What's this green box all about? We have thousands of choices of stocks, thousands. You can buy stocks that are valued at $200 million, which would be a tiny micro cap. And you have Apple at 3.4 trillion that everybody knows what Apple does. And so which ones are the best ones, right? Warren Buffett talks about moats. When I did my MBA work, we talked about barriers of entry, and they make a lot of sense. A moat is a barrier of entry. It separates a company away from its competitors. And if that competitor has clear separation, either through their better technology like Google search, it was just better. It was way better. So boom, Google search, 90% market share of search. And you have an expanding addressable market, an expanding marketplace. Like Google search just completely disrupted advertising as it was before. Print advertising went way down. Advertising on TV, way down. Advertising, in newspapers, gone. Why? Businesses realized there was better return on investment by using Google search, AdWords, and they spent their money there. Google became so strong in that space that they're pretty much a monopoly. And they were just deemed a monopoly by the government. They said, hey, you're too good. You're not supposed to be that good. I get it that we teach everybody to be the best you can be, but Google, we don't like that you were the best you could be. And you basically out innovated the whole world in that respect. When they started search, everybody laughed at them. You're starting a business on something that nobody cares about. Well, everybody cares about it now. So Google is squarely in the green, beautifully in the green. And then there's businesses that are in the red, and red is really bad. These are companies that have too much competition. They have competitors at every corner. They have low margins. Their universe is contracting. Think of the broadcast station, the linear TV stations. Their marketplace is shrinking. They have competitors, and they have competitors in the form of YouTube, Netflix, new competitors that are strong, well capitalized. So I stay away from the red. And I'm looking for companies that have long-term, very long-term value to them. So back to Lululemon and Nike. Why do I like Nike and Lululemon? Is there's only one Lululemon. There's only one Nike. Nike has been so good. They are a dominant market share leader, and they beat out some pretty strong companies like Adidas, Converse, way back when. Lululemon created a new category, and they are a very appreciated brand. And, people love their product, especially ladies. So when I look at a brand and I look at a company and I look at their track record and what they were able to do, I think very highly of both of these companies. So I'm a Nike investor. I know it's been kind of a rough road for the last 3 months, 4 months, but I think the best is yet to come. And I feel like I'm going to wake up 5 years from now and Nike is going to be working for me, and they're going to make me money over the next 5 years. I'm going to wake up and stock price is going to be $200 a share 5 years from now. I think Lululemon can do the same thing. Let's take a look at what they've got to show us. They announced yesterday, and they keep growing their business. This is annual. This is really nice growth. They are a $10 billion company. Impressive. Very good. Their balance sheet's probably really good, but let's take a look at here. And now, apparel is not like my favorite industry, but when you talk about Lululemon, I have a lovely wife, and she loves their products. And when we go shopping together, and you notice how I said together, we go shop. I love spending time with my wife, and she does stuff that I like to do, and I do stuff she likes to do, and shopping is what she likes to do. And I notice how much they charge for these leggings, and you're like, whoa, that's a really expensive garment. That's incredible that they could charge that much and have that much demand. So I think they have pretty good margins, and we'll take a look at that next. But overall, the balance sheet, cash on the balance sheet, 1.6 billion. We have total debt of 1.4 billion. So they can pay off debt immediately if they wanted to. That's a very low debt level. They're a $10 billion revenue company. 10 billion. Gross profit, 5.8 billion. Okay. Very good margins. For an apparel company, excellent margins. Okay. And when we go to free cash flow, they're growing their free cash flows. They're 1.7 billion in free cash, and they were once 386. So they're growing their company 1.7. If I multiplied it times 30, I would get to 51 billion. And these guys are 31 billion in market cap. Today they're trading down. So this is a stock that I'm going to do a deeper dive on, because it may be a stock that I add to my portfolio. I think over time, if they continue to expand their portfolio of products and globally expand their brand. I mean, you look at some of these brands like Gucci and These are the premium and Italian brands, right? They started in one product, but then their brand became such a desirable thing for people around the world. And you look at Lululemon, I mean, that is the standard of women's leggings, right? And I think it's been discounted recently. If we look at the stock recently, I'm liking what I'm seeing because I like when the stock market says, you know what, I don't care if these guys are the best leggings company on the planet. That doesn't mean anything to me right now. I'm emotional. I'm like, just really ticked off and I'm throwing stuff around my own house, breaking stuff. 49%. I'm lowering the stock price by 49%. And investors like myself are like, all right, cool. Yeah, thanks for the discount. I'm going to analyze it. If it's the right stock for me, I'm going to buy it. Because over time, if I buy when the market's, selling off, that's where I stand to make money over the next 5 years. That's where I get stocks that are quality stocks that are expanding their marketplace, they're expanding their profits, that are expanding cash flows. The whole thing is expanding. It's a very organic growth of that valuation. And I like stocks that make money while I sleep. They just keep going up in value. Wake up 5 years from now, it's worth more. So I like Lululemon. I wanted to showcase that one because it's in that area of interest for me. And I think as I live stream more for you, you understand my train of thought. Investing or trading, there's thousands of stocks to pick from. There's hundreds of ways to invest. I'm a little more long-term minded investor. I like buying stocks that are going to make money over time. You have a good portfolio, that thing just cranks out appreciation and some income. And I love seeing that. I feel like I'm building this farm of great stocks that are just going to keep producing. If I want to take a couple weeks off, no problem. My portfolio is going to be fine. It's high quality. So that's my way. My methods are for long-term investing, and hopefully you guys are going to getting value out of it and find it interesting. Shadow Guy, curious of how deep your analysis goes for pharma stocks. Very good question. How do I look at drug trials, approvals, etc.? So in some cases, it does. So I'm going to show you. So pharmaceutical, let's talk about pharmaceutical. And let's start with Pfizer, because I did go pretty deep with Pfizer. Pfizer is one of my stocks that I hold. It is a stock that I think is undervalued. And I'll show you where I went. And with my the answer is yes. I look into them. I can go into United Therapeutics. I'm going to talk about Pfizer probably for the next 10, 15 minutes to show you how deep I went and what I found and how that comes into my overall review of the company. Did the same thing with United Therapeutics, Catalyst Pharma, because when it comes to the pharmaceutical industry, if a drug gets approved and a drug is successful in the marketplace, it causes a big impact on the value of the company. These companies have to spend so much money doing the science to try to create a drug, discover a drug that's going to help people with a disease or a condition that they need improved. And once they get through that whole investment in that drug discovery, which creates zero revenue, they get approved and then they go to market. That's a big event. And then if it's successful in market, like Eli Lilly's been really successful with the weight loss drugs, then you see the big payoff in pharma. Very good pharmaceutical companies have a track record of doing that successfully. They have very good scientists. They have a whole infrastructure and a whole culture of just being successful in drug discovery. So let's talk about Pfizer. So Pfizer is a long-standing company, started in New York. has a very, very successful track record. Most recently, they've been successful at, along with one of their partners, in the COVID vaccine. And I don't know if this is going to be, well, they're getting big into oncology and cancer breakthroughs. And I wanted to highlight one company they acquired. Back to Shadow Guy's comment. I don't know if this is going to get me there. Yeah, here it is. So first, when I look at Pfizer, they did the COVID thing, super impressive. The time to market, super impressive. So it shows that these guys have an infrastructure, a talent pool that is awesome. They acquired and they made a ton of cash. When you look at Pfizer and you look at cash flow, and they did all these vaccines, and everybody, needed to get vaccinated so they wouldn't get super sick from COVID. They went from being a $10.5 billion market cash flow generating company. And for a couple years, they were printing money. They were like $56 billion of free cash flow in 2 years for that COVID vaccine. They're like, sweet, look at all this cash we have. What do we do? Do we gold plate our offices? No. Let's be smart. Let's go buy this company, CGen, because they are on the edge of bringing treatments to cancer patients that are going to extend their lives substantially. These guys are going to add $5 billion of revenue to the company. They're going to really enhance Pfizer overall. So they did something smart with all that money. They acquired a company. They made their business stronger, better. So when you talk about, how far do I go with a pharmaceutical company? Yes, go that far, because pharmaceutical companies will have a patent that will expire. And then once it expires, they go generic and the profits go away. Or a pharmaceutical company may have a drug that's working, but another pharmaceutical company comes out with a better drug, and it basically cannibalizes what, the first drug, that marketplace that they had. So it's good to see that Pfizer is just reloading. It's almost like a football team. Back to football, man. Got football in the brain. It's your team's already good. But all of a sudden you're like, hey, you know what? We're going to get Patrick Mahomes to be our quarterback. Yeah, sweet. That's going to improve the team. Sweet. These guys are like, okay, we're good. But now we're going to add CGen. That's going to add a whole category of new treatments that are already FDA approved, that are going to be going to market. Beautiful. I like that. I like that about Pfizer. And I think Pfizer is misunderstood. I could show you financials and show you that the market, I just showed you how Lululemon was sold off. Market's like, the stock market, again, stock market's really irrational at times. Between the time before COVID up to the top, it was a 55 appreciation. Now that's rational, where the market said, hey, Pfizer's a good company. They just discovered or co-developed the vaccine for COVID. We like them. Up 55%. And then they're like, what do you mean COVID's not going to be around forever? No. Well, we think that the company's terrible. Really? How terrible? 57% terrible. That's interesting. But from the time that before COVID to the low point, the market sold them off by 33%. The difference between the company, this is what's interesting about an irrational market. This is before COVID, generating 10.5 billion. This is after COVID, half the run rate, but if you look at the quarterly, they're going to be above that $10 billion figure. When you look at the revenue, before COVID, 40 billion. After COVID, 55 billion. So they're substantially bigger after COVID. Now COVID's completely out, right? COVID was a big number. So this is one where, I got to look at the big picture and then rationalize this pharmaceutical company. But I do go down to what drugs are coming, what's their portfolio look like, when are patents going to expire. And I look at that along with what is their infrastructure and their scientists. If they have scientists that are brilliant, they're going to create more, treatments and drugs for the next generation of treatments for diseases. So that's my spin on Pfizer. And I can go through similar talk track on United Therapeutics, which is super interesting. I'm looking at what they're going to come up with next. Catalyst Pharma acquired another company that had this really interesting drug. So these companies are really smart. They're smart scientists doing the biology and all the chemistry to create these drugs, but they're also smart with their money. They're like, okay, now that we have all this money, let's make ourselves stronger. So good question. Thank you. All right. So let's take a look at the market and then I'm going to land the plane. NASDAQ is up 90.19, excuse me. S&P is up 0.67. I'm liking the green on the screen, man. I'd like to close out August on a positive note, and it looks like the market is going to do so. That'd be really nice. That'd be really, really nice. All right, everyone. So we opened the market together. If I missed a comment, please, now's the time to tell me, hey, check out the symbol, because I'm going to begin to shut this down and move to taking a look at my portfolio. I got to sell that DELL stock. I had fun with it, but what if I lose a few bucks? We'll see. Oh, okay. I'm up $1.32. So I made $13.22. I better hurry and catch that gain. But everybody, it's been a great week. I've streamed on stocks and pretty much everywhere, right? You can get to this site every day at 6 a.m. Pacific, which is 9 a.m. Eastern. I think it's a good time for me because I think I'm getting my head in the game each morning, trying to see what I'm going to do with my investments. And I think I could be of most service to you guys at this point because I'm kind of like in the theory kind of zone of the day. And I'm going to keep doing this. I'm going to keep doing it. Look for me on stocks. I'll be here. And you can also find me on Discord. You can find me. Let me put that up really quick. Here we go. And try to get my